Welcome back to Alpha Recap, your quick, no-nonsense look at what moved markets after the close. I'm glad you're here. As always, if you have questions, you can reach us at stockalpha.ai. Today we're digging into a tech-led pullback and a defensive tilt heading into the long holiday week. My guest is Drew, a tech sector analyst who lives and breathes this stuff. Hey Drew, great to have you.
Thanks for having me. Big day. Markets closed with some clear rotation. The S&P 500 exchange-traded fund closed down about 0.1%. The Nasdaq-100 exchange-traded fund finished down about 1.7%, and the small-cap ETF fell roughly 0.5%. Those numbers tell the story. Tech led the lag, while defensives and materials picked up steam.
Wow, okay, tech really took the hit. So, what really stands out here is why that happened today.
A few mechanics came together. First, there was profit-taking after recent rallies. Momentum names tend to retrace. Then you had fresh regulatory and company-specific headlines that made traders more cautious. And finally, with summer liquidity thinning, positioning ahead of a holiday week can amplify moves. So this was partly technical, partly news-driven, and partly seasonal.
Right, and you mentioned regulatory and company headlines. Is that mostly in tech or spread across other sectors?
Mostly concentrated in growth and momentum names, but we also saw sector-specific stories elsewhere. Things like cannabis regulation, utilities project updates, and materials funding news. Those created pockets of volatility in smaller names, while money rotated toward energy, materials, and utilities.
Not a great day for momentum, huh?
Yeah, that tracks. Momentum traders were more exposed, and they pulled back. Analysts note this looks more like a pause in rotation than a wholesale fundamental derating of the entire tech sector.
Okay, that's reassuring to hear. Quick reaction. Defensive sectors and commodity names did well. Tell us why energy and materials popped today.
Geopolitics and supply talk. Headlines around the Strait of Hormuz and commentary from OPEC put oil sensitivity back in investors' minds. When folks worry about supply, even for a short window, energy and related materials benefit. Plus, rare earths and mining picked up attention because of funding and strategic supply conversations. So capital rotated toward income and commodity-linked areas as a hedge.
Got it. And utilities showed strength too, right?
Yes, utilities acted like a safe haven. Companies gave updates on nuclear projects, storage, and solar initiatives, which suggested more visible long-term cash flows. When investors wanted to hedge volatility, utilities provided that defensive exposure.
Let's walk through the sector rundown. Quick bullets. Tech, energy, materials, utilities, financials, small caps, consumer. Hit the highlights for listeners.
Sure, technology underperformed. The Nasdaq-100 ETF's larger drop shows momentum names pulled back. Energy and materials outperformed on geopolitical and supply-side headlines. Utilities drew safe haven flows on project news. Financials were mixed. Some banks showed strength in loan pipelines, others faced legal or credit noise. Small caps lagged, which reflects caution around cyclical exposure and funding for smaller firms. Consumer and retail were generally weaker versus defensives. And then there were idiosyncratic moves in cannabis, real estate, and industrials tied to regulatory and project-specific news.
That paints a clear picture. I want to pause and make sure our listeners understand one technical point you mentioned earlier: support and resistance. Explain that in plain English.
Absolutely. Think of support as a floor and resistance as a ceiling. Support is a price level where buying tends to step in and stop a slide. Resistance is where selling tends to slow a rally. If an index breaks support on heavier volume, that raises the chance of a deeper pullback. If buyers come back at support, it can signal the move was just a pause. Traders watch these zones closely because they help gauge whether rotation is temporary or more structural.
Nice, simple, and useful. Now on individual stocks. There were a few notable movers. Give us the short list and why they mattered.
Sure. Dynatrace got attention after first quarter commentary and analyst note updates that stirred debate about growth sustainability and margins. Ford reacted positively to a reported quality milestone and comments about smoother vehicle launches. A couple of regional banks, like Western Alliance and Independent Bank, were under scrutiny as analysts reevaluated earnings and asset sensitivities. Netflix kept a spotlight thanks to a bullish coverage piece outlining a few reasons analysts like its positioning around content and ad-tier monetization. RTX, formerly Raytheon Technologies, moved around post-earnings as investors digested defense spending visibility. And BJ's and some smaller names saw analyst-driven volatility, which is typical for names that are more news-sensitive.
Interesting mix. So it wasn't just tech getting repriced. Regionals and smaller names were active too.
Exactly. When big sectors rotate, smaller and regional names often amplify the move because they're more sensitive to funding and sentiment changes.
Quick segment of reactions.
Yeah, absolutely.
Honestly, I was a bit surprised by the material strength.
Me too, in the short term.
Okay, now let's talk macro and the Fed. We know there weren't big data prints today, but how did Fed commentary and inflation expectations play into this session?
Good question. There weren't headline macro surprises, but the market is digesting the cumulative trend. Some parts of the economy have been gradually disinflating, while services inflation and wage pressures remain sticky. Analysts say that mix keeps the Federal Reserve cautious about cutting rates too quickly. As a result, investors have priced in a slower pace of policy easing. Hawkish-leaning comments by Fed officials have caused short-term volatility in rate-sensitive sectors and leveraged growth names, which aligns with the tech pullback we saw.
So the takeaway is the Fed is still the main macro risk.
Yes, Fed communication remains the principal near-term catalyst. Any surprising inflation print or unexpectedly hawkish language could push rate cut expectations further out and widen the pullback, especially for growth and small caps.
Let's give listeners some practical, non-advice framing. What did today's internals and breadth show, and what might that mean going into next week?
Breadth was mixed. Winners were concentrated in a few sectors: energy, utilities, materials, while many groups were flat to down. Technically, the market looked like it was consolidating after months of divergent leadership. If support zones hold and macro data doesn't surprise on inflation, we could see cyclical names try to reclaim leadership. But if inflation surprises or Fed talk turns hawkish, we might see a broader pullback led by growth and small caps. So near-term bias felt neutral to cautious.
Important nuance there. Fillers aside, so what should traders and longer-term investors be watching this week?
5 things. 1. Fed commentary and data flow. Any jobs or inflation-related headlines matter. 2. Tech earnings and company updates. Continued profit-taking or earnings misses could extend pressure on growth names. 3. Geopolitics and commodities. Developments near Hormuz or unexpected OPEC moves can yank energy and related cyclicals. 4. Sector-specific catalysts. Regulatory news in cannabis, project milestones in utilities, and mining funding can create idiosyncratic trades. And 5. Liquidity and seasonal patterns. Thinner summer volumes mean headline-driven moves can feel exaggerated and reverse quickly.
Short reactions again?
Right, short-term caution makes sense.
Hold on, say that again.
With thinner summer liquidity, headlines matter more.
Good to note. Before we wrap, we need the mandatory reminder.
Right. This conversation is informational only. It's not a recommendation to buy, sell, or hold any security. Analysts note the market is repricing risks and rotating exposure, but this is not personalized investment advice. Consult your own advisor before making choices.
Perfect. Final rapid-fire takeaways. Give listeners 3 crisp points.
1. Tech-led weakness drove the session. The Nasdaq-100 ETF fell about 1.7%, outpacing the modest drop in the S&P 500 ETF and the small-cap ETF's roughly 0.5% loss. 2. Money rotated toward energy, utilities, and materials on geopolitical and sector news. And 3. Fed talk and inflation dynamics remain the main macro levers, so expect higher sensitivity to headlines and thinner liquidity heading into summer.
Awesome. That's a great wrap. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening. We'll be back after the next close with another Alpha recap. Stay curious.